Social Security is slowly but surely running out. So you're going to have to take control of your own retirement. Hello everyone, my name is Zach and welcome to On Cashflow, where I help you become a master of your own cash flow. Now let's get started. All right, now first things first, we need to first find out what your actual Social Security benefit is supposed to be. And the best way to do this is actually just go online. So they have the My Social Security account. You can register on there and it's supposed to give you an estimate of what your future Social Security is supposed to be based on your past work history. And it's all going to be in there and it keeps updating every single year. After you file your tax return, the information on how much you paid into Social Security and how much you made that year is supposed to be passed on to them, and then it gets updated, and then your new, whatever your primary benefit is supposed to be when you go to retire, that is supposed to be updated online. On the My Social Security page is really simple, but there are a few very important things on here once you actually get on there yourself. The first thing you're going to want to look at is your Social Security statement. So this is a really important all-encompassing document that has a lot of good information about your potential Social Security benefit in the future. The next really important thing to pay attention to on this website is your earnings record. So you always want to make sure that your earnings record is correct. So this should actually reflect your taxed Social Security income. Whatever income you paid FICA on, this is what's supposed to be reflected here in your earnings record. And then lastly, towards the bottom of the website, you can see it shows what your full retirement age is supposed to be. For most of us watching this, it's probably going to be currently age 67. And then it also tells you what your Medicare age is, which is currently supposed to be age 65. That is basically the gist of the My Social Security account. And if you haven't already, no matter what your age is, you should probably have one of these accounts so that you can monitor this. But now let's take a quick look into my actual estimate for my Social Security. So actually what you can see on here is that I actually haven't earned 40 credits yet. So the way that you qualify for Social Security is at a bare minimum, you have to have 40 credits and you can earn a maximum of 4 credits per year. So that means that you have to have at least 10 years of work history of paying into Social Security. And while I do have 10 years of work history, I don't necessarily have 10 years of work history that paid into Social Security, because there was a point in time when I wasn't paying into Social Security. I had a few jobs that were exempt from paying into Social Security when I was in college and working out of school. You can also see on there, on my most recent earnings record, how low it is. So the most recent earnings record for me, $4,556 in 2022. And this was literally only profit that was made from YouTube. This is why it's important to pay attention to your earnings record to make sure it is accurate, because this is only supposed to be what is actually taxed by Social Security. Now, I actually had plenty of other income besides just that amount, but it was not subject to Social Security tax, and that's why it is not reflected right here on this page. After I file my next taxes, I should have an actual estimate because I should have 40 credits by then. One thing that when it comes to Social Security is really complicated, but everyone wants to know, is how that benefit is actually calculated. And that's what we're going to get into next. But really quickly, I just want to say that even though we're talking about a potential Social Security benefit in the future for all of us in retirement, I think that you should never completely rely on Social Security or never rely on it as a significant source of your retirement potential income. Instead, what you need to do is invest yourself. And luckily for you, I have a complete guide to investing that I do want to share with you at the end of this video. But getting on to the Social Security benefit calculation, the way that it basically works is that you have to have at least 40 minimum credits, like I mentioned earlier, and that is at least 10 years of work history. But if you just had that bare minimum, your Social Security payment is going to be very, very low. The amount of your calculated benefit is not based on only 10 years of work history. That is the bare minimum. It's actually based on 35 years of work history. So if you only really had 10 years of work history, yes, you might qualify for Social Security, but you're going to have zeros that are in place for the rest of that 25 years, of which the 35 years is being calculated. And I don't think it's necessarily important to look into see how the calculation is done step by step, because it's a very weird formula, the way it's calculated, what they call your primary insurance amount, which is the amount that you're supposed to get when you retire. But there is, thankfully, a very simple calculator that you can use on the Social Security website. And plus, of course, it has that actual real life estimate based on your work earnings history. So the real life simple calculator, I would recommend using that because you can estimate what your future income is going to be, and it will spit out a number based on how many years you worked and how much you made, and it'll go and do all the indexing for you and all that, because it has to adjust upwards for inflation. And it'll do all that, and it'll spit out a primary insurance amount that you can actually use as a realistic estimate for your future Social Security. However, the main point of this video is not necessarily how much Social Security you can expect to get in the future. It is the doubtfulness of the future sustainability of the current system and the current amount of taxes we pay in versus the current amount that Social Security has to pay out in benefits to beneficiaries. Before we talk about the future of Social Security, I just want to say really quick that I put a lot of effort and research into all of these videos, and it would really help me out if you just took a quick second and hit the like button on this video. Thank you very much. All right, but let's get on to the future of Social Security and what might be in store for the system. So right here on the Social Security Administration's statement that they give us, it even says that it is estimated to be fully payable until 2034. And then, if nothing changes, 80% of current benefits are going to be covered. That was taken directly from the Social Security statement that you get on your My Social Security account. However, I did some more research and tried to find if there is any more recent data that we can look at. And actually, there was a recent report by the Board of Trustees for the Social Security Administration, and they actually said in the most recent report that I could find that it was fully payable until 2033, and then they could pay 77% of the current benefits. It seems that every year, the amount that it could pay is being reduced, and the year that is expected to be fully payable is also being reduced. So we're inching our way closer and closer to not being able to fully support the amount of payments that are promised right now. And I'm sure most of you are already pretty well aware of this, that something is going on to where we're not paying enough into Social Security versus how much is actually being paid out. But this really begs the question is, how should you, as someone on the path to financial independence, on the path to potentially retiring early, account for Social Security in your retirement plans? And before we get on to trying to answer that question, this leads me to the big question here. I want to know from you in the comments below. What do you personally think is the future of Social Security? Do you think that we are going to have to pay higher taxes? Do you think that we are going to have to reduce the amount of benefits? Do you think that we're going to have to increase the retirement age? Or all of the above? Please let me know in the comments below. I'm really curious to hear what you have to say. And now getting on to how I think that we should account for Social Security while we're on the path to financial independence. The longer that you have until you're supposed to reach that full retirement age, I think the more uncertainty there actually is. The more likely changes are going to happen, probably negatively for you, the longer that you actually have to retire. For example, in my current age, I have about 38 years until I reach my full retirement age of Social Security. A lot is going to happen in 38 years, especially when it comes to the Social Security system and the fact that it's supposed to not be able to pay its current benefit promised amounts within the next 10 years. So there is a lot of uncertainty when it comes to people in my age group. Whereas if you're already in, let's say, your late 50s, then you might have a little bit more certainty. You might have more certainty once you actually start taking those benefits. And certainly, I think the people with the most certainty are the ones that are already taking Social Security, and they already pretty much have a locked-in amount that they are promised to be paid. I think it's less likely that people who are currently getting payments and people who are about to get payments very soon are going to be affected as negatively as someone who has not received any payments and will not receive any payments for many, many years to come. People who are currently in their 20s, 30s, and 40s, they have the most uncertainty to what their potential payout is going to be in the future when they retire. But I'm not going to just leave you with that. I want to leave you with something that is more concrete. And that's why I think that there are 3 good options that you could pursue when it comes to accounting for Social Security in your early retirement lifestyle. The first one is to just simply use the Social Security Administration's estimate, whatever is on your My Social Security website. And I think this is more applicable if you are already in your 60s, already in your 50s, then I think that you can, with a high likelihood, rely on that estimate that they are giving you. However, if you're earlier than that, I don't think this is necessarily a very good option. A second option, I think that could be good for someone in the younger years, maybe currently in their late 30s or in their 40s, is to use about 70 to 80% of their current Social Security estimate. And the reason for that is that it says right there on the statement, and the Board of Trustees have said it, that at the current rates, the Social Security Administration is not going to be able to pay 100% of the benefits, and it's actually closer to 77% currently is what the estimate is by 2033. If I was, let's say, in my early 50s, maybe I would look at my Social Security statement and say, well, I have more than 10 years until I retire, and the Social Security Administration is not expected to be able to pay 100% of the benefits in the next 10 years. And so maybe I should just take this estimate and adjust it downwards by, let's say, 25% or 30%, depending on how conservative you want to be, and say, this is probably a more realistic amount that I could actually expect once I retire. Third possible option I think is good for mostly people that are, on the younger side, maybe in their 20s, 30s, and early 40s, would be to actually just not think of Social Security as a part of your retirement plan, and instead think of it as they say, icing on the cake. Is that how you put icing? No, that's sprinkles. Icing is like this. Basically meaning that you don't actually put Social Security into your retirement plans. And if you're someone that's on the path to financial independence, you want to retire early, it's probably not even something that you're going to include anyway. And if you were including it, the way I think it would be good to look at it as just extra income that is a kind of like a windfall once you reach your 60s or whatever the age happens to be once you reach that age. This is currently what my decision is when it comes to my retirement planning. I'm not going to actually put Social Security benefits when I run my calculations. And instead, I'm going to look at it as, hey, when I go to retire, let's say it's age 70 is when my full retirement age is going to be at that time. Whatever that income that I do receive from Social Security is going to be, just a little bit of extra benefit. And I'm going to use it to pay maybe some increased costs that I'm going to have at that age. Or maybe I just want to go ahead and enjoy a very luxurious travel lifestyle, whatever it may be. So I'm looking at that as just extra income, just as a windfall at my age currently, because there is so much uncertainty over the next 38 years when I might actually reach my full retirement age. But the bottom line is, don't worry about it too much. Don't rely completely on Social Security. Definitely don't rely on it for a significant amount of your retirement. If you're on the path to financial independence, you're going to have to invest your way to retirement yourself. And in order to do that, you need to know one of the best ways to invest your way to retirement. And that's why I did make a full guide for you that if you haven't watched that video, I definitely recommend you need to watch that video already. Okay, it's going to pop up right here on the screen right after I get off the screen. Thank you so much for watching this video. I'm Zach from OnCashflow.com, and I hope to see you next time. Next year after, now really quick, before we talk about the future, and if you actually look back at, what do you personally think is the future?